Hey everyone, welcome back to Corporate Decoder, the place where we make sense of corporate filing so you don't have to. Today we are diving into a document from the Federal Home Loan Bank of Atlanta. Do you know what kinds of surprises await us? It's quite a home loan adventure, so stick around 500 before we start. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can chat about all things finance. In short, this report is about the bank issuing new debt called consolidated obligations. It's how they raise money to fund their operations. These aren't your everyday loans. They're a joint effort by all the federal home loan banks. Let's get into the details, folks. This report is dated July 20,000, which tells us this is when the event being reported occurred. This is important because it sets the timeline for all the information we are about to see. The core of this report is about the creation of a direct financial obligation. In simpler terms, this means the Federal Home Loan Bank of Atlanta is taking on new debt. They do this by selling securities called consolidated obligations. The money they get from selling these securities is what they use to fund their lending activities. This is a normal thing for banks that make loans. Here is where things get interesting. Schedule A lists all the new bonds and notes the bank is issuing. It gives us a snapshot of the bank's recent borrowing activity. This is where you will see exactly how much money they are borrowing, when the loans need to be paid back, and what the interest rates are. Think of it like a detailed receipt of their debt transactions. Let's dive into the details found in Schedule A. Keep in mind that this schedule contains a lot of technical information. The first line is about trade date. This is simply the date when the agreement to buy or sell the bond was made. For example, we see several trades made on July 2, 2025. Knowing the trade date helps us understand when the bank initiated these borrowing activities. Next, we have the CQSP, which is like a serial number for each bond. It's a unique identifier that helps keep track of the specific bond. You can see a series of USPs listed like 3, 4, 13. All it's important for financial professionals, but for our overview today, you don't need to memorize these numbers. They don't reveal important details. The settlement date is when the actual exchange of the bond for cash happens. We see settlement dates like July 16, 2025. These dates tell us when the bank actually received the funds from the bond sales. The maturity date is when the bond needs to be paid back. Looking at the maturity dates like July 7, 2028, we know how long the bank has to repay these debts. Longer maturity dates mean the bank has more time, but also have to pay interest payments for longer. Next pay date, the date when the next interest payment is due. Seeing dates like January 7, 2026 tells us when the bank has to make its next interest payment on these loans. Scroll, type, tikai, perhaps, if, and how the bank can pay off the debt early. We see designations like optional principal redemption, which simply means that the bank has the option to pay off some of the money they owe early if they want to. Scroll, call style to true. To scroll to call style. If there are options to pay the bond early, this describes when the bond can be redeemed. With Bermudan, the bank can redeem the bond on specific recurring dates. Fixed constant means the interest rate stays the same over the life of the bond. Scroll. Next call date if the bond is call. Next call date. If the bond is callable, this is the next date when the bank can choose to pay it off early. For example, if we see October 7, 2025, the bank might choose to pay off some of the money they owe early on that date. Coupon PCT, or coupon percentage, is the interest rate on the bond. Looking at rates like 4.5, we know how much interest the bank is paying on these loans. The interest rate on bonds is called the coupon rate, hence the name. Kroll bepank kiwajen, kipi parkshis kroll, Bank par, which is the par value, is the total amount of the bond being issued. Amounts like 15,000 are how much money the bank is borrowing with each bond. So in this example, it's $15 million. Moving on in the schedule, we also see trade dates from July 3, 2025. This shows that the bank was actively issuing debt securities around this time. We have different CQSE numbers like 313-140, B6YD2, indicating they are different bonds. Settlement dates like July 14, 2025 show when the bank is receiving funds from these bonds. Shorter maturity dates like January 14, 2026 mean the bank needs to repay this loan in the near term. And next pay dates like October 14, 2025 indicate when the bank has to make its first interest payment. Here we see a non-choppy bond, which means the bank can't pay it off early. with an NRA listed for call style and next call date. We confirmed that this is indeed a non-callable bond, so it cannot be paid off early. The rate type is variable single index floater, which is an interest rate that changes based on a single index of some kind. Significantly larger par values, like $1,000, $1,000, mean the bank is borrowing substantial amounts with these bonds. Alright, that's our dive into this SEC filing TUTID. Now for my thoughts on this report in light of the broader Federal Home Loan Bank system. While this specific filing is pretty dry, it's also extremely important. Think of the Federal Home Loan Banks as the lenders to 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 Vice Lencrave. The Atlanta branch, like the other 10, plays a critical but often unnoticed role. When they issue debt, shown as consolidated obligations in this filing, they are directly influencing the availability and cost of loans in their district. Here are a few things that stand out from the outside forth. The interest rate shown in Schedule A, around 4.54.875% for bonds maturing in a few years, reflect the broader interest rate environment. If these rates are sustainable, we will see stability. If they are paying too much, they will bleed cash. The issuance of variable rate notes, especially in such large amounts, $1 billion each, suggests they are trying to take advantage of potential rate drops. But they are opening themselves to some interest rate risk. If rates go way up, their interest expenses rise too, so they play with fire. Boom too. Remember, this is just one small piece of the puzzle, but it gives us a little insight into how this part of the financial plumbing works. Alright, that's a breakdown of the Federal Home Loan Bank of Atlanta's latest filing. What's your take on these numbers and what they signal for the bank's future strategy? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.